this is John Dunlevy back with another video, and I've been asked to talk about tax loss harvesting. I know that's kind of like a $50 word, but it's really kind of a simple concept. And really what we're doing is we're trying to minimize your taxes that you have to pay at the end of the year by offsetting gains with a loss. So it's like I'm going to take a loss and combine it with a gain in order to minimize the gain and minimize the actual taxes you pay at the end of the year. The key to tax loss harvesting, though, is you have to kind of harvest long-term capital losses. You have to offset long-term and long-term. So what does that mean? That means 12 months. You have to hold something for 12 months or one full year before it's eligible for long-term capital gains or loss treatment. So for instance, let's suppose you sell a stock and you have a $25,000 gain. Now, if you do nothing, at the end of the year, you have to pay $25,000 times your ordinary tax rate. So if your ordinary tax rate is 25%, it's 25,000 times 25%. At the end of the year, you're paying tax on that. But the beauty of tax loss harvesting is if you go through your portfolio, and let's say you own 50 positions in your portfolio, and there are 2 or 3 that qualify for capital loss treatment. So really what you want to do is pluck those out. So that means we're going to apply a long-term capital loss against the long-term capital gain and basically net them out. When you do that, particularly if your loss is greater than your gain, you've basically offset that $25,000 gain that I just described before with a loss. So let's say you have a loss of $30,000. So the net long-term loss now is $5,000. Now the beauty of that is that you can carry that over unlimited number of years. So you have basically an asset on your balance sheet, if you think about it that way, that you can carry forward in the future to offset more gains. But the other thing that the tax code allows you to do is you can take $3,000 of that $5,000 and recognize it against ordinary income in the current year. So when you do that, you take the 5 minus the 3, now you have $2,000 that you're applying as a long-term capital loss going forward. The word harvesting really is an appropriate word for this strategy because you're really being aggressive to minimize the taxes you pay every year. This is John Dunlevy at Monorail. Thanks for coming aboard, and I'll see you in the next video.